women hate talking about money. It's a generalization, but it's factual. And they don't actually equip ourselves with the information that we should. We leave it to other people. And as we all know, everyone needs a Natalie in their lives. Natalie, I'm going to, I've made you co-host, I think, so try and share your screen.
Okay.
But I'll put you on, before you do that, just before we start, can we just, little tip for you, blah, blah, blah. I don't know what Nikki's saying, but I wondered, Natalie, if I could just ask you to tell us a bit about yourself and your heritage, really, because you're actually a financial person who knows what they're doing, and you've got a really interesting heritage. So,
no problem.
Who are you?
Well, I'm Natalie Jhingoree-Smith, and I am a senior financial consultant within Wesleyan. So what that means is I spend my time specifically with people within the legal world and professionals offering financial advice from mortgages right through to estate planning. I feel quite proud to be in finance because I sort of fell into it, and it was like learning a foreign language. You know, it was overwhelming. And I feel like my heritage is massive because my granddad was from Guyana, and he came over to England in 1960 and became a print. He did professionally, he was very, very successful. And he's always driven me to find a career. But I was one of those people that just didn't know what I wanted to do. But being in finance has been fantastic because being from all different cultures, so my granddad's from Guyana and my dad was born there and came over when he was 5 months, and my mum is English, has meant that I've always enjoyed people, and our family is massive. So it's given me an ability to talk to people, but mainly about their finances, which weirdly, once you get people talking, is the key to all of their dreams and aspirations, which I love because I get to help you get there.
Fantastic. And one of the things you say is that because you're used to dealing with barristers, solicitors, partners, you know, and non-lawyers, you know that we don't like to fill in forms, and we are, so, you know, before lockdown, you know, it's a big issue in our sector.
I know.
About stuff, but we rather keep on having crap service suppliers than actually finding the time, and we've got to just get real and admit it. So, I mean, you go to people's houses, people's offices, you know, you really have to hound people, don't you? Which I know is not right, but we just haven't got time. And so, you know, you really do understand the pressures of the profession.
Massively. Yes. Yeah. So and I think you work a lot. You know, it's not just that you're saying that you don't want to do stuff. I appreciate that time is really precious. And so I try and fit around that family lifestyle.
Yeah, thank you. Natalie, I'm handing over to you.
Okay.
And let's start with some of your tips. Thank you.
Okay, well, I think I'm just grateful that you have given some time to talk about your finances. And what I do is I have a presentation, which is a PowerPoint presentation, but to make it so it's not death by PowerPoint, I think that we're looking at sort of 5 tips to financial planning. So some of this will be relevant to you, some of it won't. And everyone's at a different position in their lives, got different goals, aspirations or dreams. So we'll stop after every point. And if you've got any questions, ask. Some of the questions, you know, it may be a better spent time discussing it individually. Sometimes I'm going to give very, very generic advice and it may not actually affect you. So come back to me if you want any specifics and more detail. But let's start off the presentation. So can you allow me to share my screen, Sally?
I thought I did, but forgive me. Hang on.
Don't worry. I'm not the best techie person, so bear with us.
Just try it now.
Okay. Excellent. Thank you, Sally.
Yeah, perfect.
Cool. Excellent. So this presentation is really looking at 5 things that you should ask me. You may not want to ask me these things immediately, but over the lifespan of your finances, you're going to probably touch base with some of these things. And we're going to touch on COVID and how that can affect you as well, because it has been a time where I've had many panicked calls from clients, and it's good to talk. Do not bury your head in the sand, because I've also had to deal with that, and that can have a long-term adverse effect on your planning. So you probably think, who are Wesleyan? You know, what do I do? So I have actually been I've been in finance over 20 years, and I've been 5 years with Wesleyan, and I love Wesleyan. They're based in Birmingham, and they've been around 170 odd years, and they're one of the few mutuals left. So what that means is they don't have any shareholders. So all the profits go back to policyholders, which can be a real benefit to you if you look to obviously get us to help you. I specifically spend my time with people within the legal world and professionals, and we have an advisory board with quite eminent people within your world, and they enable us to try and create a panel to suit your financial needs. And we've also become endorsed by the Law Society as well, so we work very, very heavily within all different remits of your world to try and get it right, so that we can support you with all your big decisions. We look at everything from retirement planning, mortgages, insurances, all the things that you probably know you should look at some point, probably dread looking at, but hopefully we can help you sort these bits out. We also have a bank, so we're very, very well known with law firms in helping fund and keep liquidity. And we have a general insurance department which help you with your personal insurances as well as some business insurances. So why should you give up the time to talk about finance? Because here I sit, you've given up an hour of your time, which you could be doing something more exciting. But most of us, we earn the bucks, we earn the Benjamins to enjoy life. We're looking to maybe our futures, we're looking to some of our aspirations, or it could be very short term. We just want to go on holiday and have a nice little drink by the beach. But getting your finances correct, I've found, is really massively linked to your physical and mental well-being. We work very heavily within this area. A lot of people, they sometimes, without really knowing it, do worry about the next thing in their bank accounts or what they should do. And it doesn't have to always mean that they don't have the money. It could just be, what do I do? How do I sort my mortgage out? So we really want to work with people that are busy to try and make sure that they're not worrying about it. They don't have a guilt list, and they just sort their finances out on an biannual basis so that they get to where they need to be. So the 5 things that may be things that you think, I should have spoken to someone about, is protection. So why bother with it? Mortgages. I spend a lot of time with lawyers looking at their mortgages, whether that's buying their first property, moving, remortgaging, or buying into a portfolio. Investments, at the point where when do you invest? What's going on with COVID? How is that affecting my investments? Whether you like it or not, you probably are investing money, whether that's personally or into your pensions, because with the auto-enrolment, most of us do have pensions that we can join. And then we'll look at some other considerations, especially around COVID and some of the things you could be making use of. So let's start off with the protection side of things. So what do we mean by protection? Well, you probably get bombarded. When you start a job, you get a massive pack through. Sometimes there's a portal with benefits. But weirdly, a lot of us just sign the contract, but please, we've gone through the interview process and we don't know actually what our professional benefits are. And that will be different company to company, or whether you're self-employed. So it's really important that you understand what you already have in place. So do you have benefits that you don't know? Do you get death in service benefit with your work? Are you part of a group income protection scheme? What is your sick pay? So if you were off long term, how long will the company pay out for? And what I found is within the legal segment, the benefits can be they can massively differ, and sometimes people can be really vulnerable. For example, you may not even get sick pay. It could be statutory sick pay, which is about £94 a week, which most of us would not really like to live on, and it wouldn't pay for all the things that we need it to. Some of us may have these heritage plans we took out years ago, we pay every month, but we have no understanding of what it does, and is it fit for purpose anymore? Did you take that plan out before you had kids? Have you got more kids? Do you have a greater mortgage? Does the plan actually meet your needs? And so what I can do is determine what you already get, because anything you get for free with work, or even if you have to pay minimal cost towards it, really should be taken. And then if there are any shortfalls, we can discuss how you want to meet them. Some people I meet, as much as I tell them there's shortfalls, they decide to take that as a self-insurance, they take it on board, but they're informed. But you can never do this topic retrospectively. So if one of you got ill and you couldn't work long term, whether that's serious or short term, you would not be able to take out anything at that point. So it's always important to know what your benefits are. I spend a lot of time with lawyers speaking about this topic, and one of the things I find difficult is that most of you do not know what you get through your work. You don't know what your benefits are. So I would always recommend you write an email to your HR department if you cannot find it in the realms of the intranet or whatever, and ask, just say, if I was off work long term, what would I get? What benefits do I get through work? Within your pension funds, if you died, the money you've accumulated in that could be paid to a beneficiary free from tax and national insurance if you're under 75, which all of you are. But you have to fill out one very simple form called a nomination of benefit form, and most people have not done it. It's an incredibly powerful document. One of my friends died when he was 40, and the money in his pension funds paid out quicker than the life assurance funds. So even sometimes it's me helping you fill out a form which you should have done, know you could have done, and just haven't done. So that's one area that you could speak to someone like myself about, is what benefits do you get through work? What have you got in place already, and what are your shortfalls, and do you want to address them? So that's the first thing. Did anyone have any questions on that topic? Has anyone come across anything that they're not sure about before we move on to the next topic?
No, Nikki's asking a question.
Oh, what's that, Nikki?
Just a really quickly random one.
Yeah, brilliant.
I have got a pension fund. I have filled out all my notice and wish of everything like that. And what I was wondering, because when I look at other people, because I'm actually single with no children,
okay,
I filled my notice of wish out to my nephews. Now, from what I can gather, they will only get the actual pot. They wouldn't get a pension, so to speak. You know, lots of people get like a spousal pension or a dependence pension, whereas I think, from what I can gather, all my nephews would get is what I've actually paid in.
What type of pension scheme are you in?
So it was a final salary, but it was shut down about 5 years ago.
Okay, it's a defined benefit scheme. Yes, you are right that at the moment, with defined benefit schemes, which are few and far between now, because a lot of companies don't have them, you would definitely get some benefits, but some of the benefits like spousal or dependents pension would not be available at this point to you. But they are still fantastic pension schemes, and there are some merits in them. So it might just be worth you having a look at what you've already built up at the moment within that defined benefit scheme. If you're going into general practice and not going to go into local government, because generally local governments are the places where you get defined benefit schemes now, you will probably find that you'll have just a normal contributory scheme where, again, the value will just be paid to your beneficiaries. But that's probably a topic that we can talk about if we looked at your overall finances. But yeah, really good point. Any other questions at all?
No.
No, let's go on then. So.
Not yet.
No, don't worry. There'll be some exciting stuff in here. So mortgages. This topic, especially at the moment, is something that will touch most of us, because if we're buying a house, we're trying to get on the property ladder, or we're trying to move, or we're building a portfolio, mortgages, you really, really want to read up about it and gen up so that throughout your life of having a mortgage debt, you really understand it. It's amazing that people go and buy a house. They probably buy a house quicker than they choose to buy a pair of shoes, because it's very, very quick, the market. But you need to really, really be informed about the options you've got with your mortgage. So there is not one rule fits all. There is not a best mortgage out there. Sometimes people are in a situation where they need to borrow more to buy that dream house. So the provider may not be the cheapest overall provider, but they are able to lend you what you need to get on the property ladder. Sometimes you're trying to get rid of the mortgage, or you don't want penalties so that you end up paying out if you need to pay the mortgage off. So it's really important that you look at every aspect of what you want before you choose a mortgage. It's not always just about low cost.
Email, but I'll send it again.
It's important to think about the moment that interest rates are really low. We know the base rate's gone down. That doesn't mean it's going to automatically follow through to your mortgage, but what it does mean is that you're going to be able to get a rate which is a lot more favourable than even 5-10 years ago, even though the base rate was still low. However, 5-10 years down the line, we don't know what could happen. So it's really important that you look at a rate that will suit your circumstances. I've spent a lot of time with people that have maybe taken mortgage breaks or been furloughed. There are still options out there if you've been in that situation. But as any mortgage, it's a case-by-case review. And some people the mortgage market literally just froze for 3 months because of surveys. And so some people may have been buying a house or had an offer but couldn't get a survey. And some lenders are extending the offers, but not all. So if you're in that process, it's really important that you look and see how long your offer is valid for. But what's important to note is if you bought a house 10, 20 years ago, it was probably a really easy process, especially if you did it through your bank where they saw your income going in. Mortgages since that point have been regulated 2 or 3 times more. So what that means is they're going to need a lot more information about you. And it's not always about the fact you've got loads of equity in your property. It's more about looking at, can you afford that mortgage? And now lenders have to actually sign off to say that they've checked affordability. So when I ask for information, I'm going to probably need to know what your income is, and I need to be really accurate about that. If you're self-employed, I will need your SA 302s and tax overviews, which your accountant can probably give you. And if you're employed, we'd need your pay slips. I'd need to know what your budgets, your outgoings are, so your expenditure. So that's really important. I'm not interested really on what you spend your money on. If you subscribe to anything, not a problem. But there are some things they will want to know about, like your liabilities. So anything, if we credit scored you that would be outstanding, they need to know that really to the penny. And underwriters don't like to be shocked. So the better the information I have, the more accurate the information I have, the easier the journey to get the mortgage will be, whether you're remortgaging or purchasing a property. So what I would say with lending is that the more information you give me, it's an investment, because I can go to the lenders and do all the work for you. But it may be a point that you need to collate some of the information, i.e. get your credit file checked. What debts do you have outstanding? Is it accurate? Because what I don't want to do is put a footprint on your file and realise that there might be something that could have happened with your file. So the time you give to your mortgage review will be really good, because it will long-term help you to make it easier as you move along. What does coronavirus mean for investments? So I spend a lot of time with people and they say, oh, I don't like risk. I really don't want to take any risk. But whether you like it or not, probably all of you have got some sort of pension fund, especially if you've joined your firm's auto-enrolment scheme. And that is an investment. So it's really important. The principles of investments don't change. I've worked for 3 or 4 different companies and had a guide to investment. The stuff inside the brochure is the same. It's just got different branding on it. So what does it mean for it? A lot of people make a knee-jerk reaction. But if I said to them, well, are you going to sell your house when the markets are down? Most people say, no, I'm going to stay in my house. I can live in it long term. So most of us wouldn't sell a property in a slump, in a market, unless we really have to. But investments, because sometimes the understanding isn't there, we've seen lots of ups and downs in the markets. People can make a real knee-jerk reaction to what they do with their money. Ideally, the worst time to take your money out is when the markets are down. So if you can keep your money invested, I would just leave it and hope it will recover. I cannot guarantee it because I've not missed it, Meg. I don't know what markets will do over the next 5-10 years. But history has shown us that the stock market and investments can have massive ups and downs. It's important when you do it that you understand that it could go up as well as going down, because we tell people this, but I think when things are going well, they're like, oh, it's amazing. But when the markets are down and they can see a significant loss, there can be an element of panic. So it's important to talk to someone on a regular basis, not just in the bad times, but also in the good times. The time to also invest is when the markets are down. So if you've got any spare cash, the time to invest is when the market's maybe not doing as well. Or if you invest on a regular basis, you get all the different market conditions. So the average unit or the average pound cost, spend is lower. You need to understand your appetite to risk. So I meet lots of people that say they don't want to take risk with their money, but then I look at their pension funds and their investments and they're in really high risk funds. And I'm like, you don't want to take risk, but you actually are in the wrong funds. So assessing your attitude to risk and making sure your money is in the right place is important. And investments, people come through to me because they find their cash savings so awful. Most of people are earning less than 1%. They want to invest, but any investment has to be kept for at least 5 years. And actually 5 years is probably the minimum. So 5, 10 plus is the best way to invest. It's really a case of, again, talking to someone and making sure, not just doing it once and then leaving it and forgetting about it, but reviewing your pensions and investments on a regular basis. Without realising it, there are loads of different funds out there. There's loads of different names and they try and jazz them up to be all exciting. But really, there are 4 main places we invest our money. Cash is what you're probably used to in like current accounts, savings accounts, national savings, cash ISAs. Great because the capital doesn't go down, but the returns can be awful. So the risk is that it doesn't keep up with inflation or the cost of living, i.e., if you've got £10,000 and you bought a car today, in 10 years' time, it probably is not going to buy the same value in car. We all understand things go up in price, but we don't always feel that our money needs to go up to reflect that. The 3 others are government bonds and corporate bonds. So that's where governments or companies borrow money and they repay it back through either their tax or their profit. Slightly lower risk because they're hugely assessed. But on the other side of it, companies and countries can default on their debts. Property, so a lot of us understand the property market, both residential and commercial are what goes into funds. Long term, they can be very, very good, profitable investments, but the markets can go up and down, the risk of people not paying their rents and things. So that is where you take a different stance to cash. And equities are where our shares, they do go up and down. I could show you the last 20 years. It's a massive up and down slope. But over the medium to long term, it's far outperformed most other asset groups. So that thermometer is showing really that the higher the risk is the higher the reward. The lower the risk, the lower the potential return that you'll get. So on that side of things, is there anything anyone wants to ask? Because I know that's one of those areas that people do ask me about, even if they haven't massively invested before.
I suppose, can you hear me?
Yes.
One of the things is that, again, a generalisation, but we just don't really understand, well, I just don't really understand the investment. I'm quite a bright person and I understand most things. I cross-examine lots of experts. But at the end of the day, if I've got cash in my purse, that's king as far as I'm concerned, or in the business or whatever it is. So it's very hard to move from that mindset where you know where your cash is, where you've got access to it. You're not giving 90 days notice. I used to have a fund that needed 90 days notice. So I only want to buy something small. That's before I had kids and became skin. So I think that's one of the issues. So I just wonder how people can get into sort of basic investment earlier on.
That is a massively important. So the answer to it is that you would never have all of your money invested where you can't access it. That would be mental, because then if you have any unexpected costs, if your car breaks down, if your washing machine goes wrong. So we would always recommend you have 3 pots. Your current account, which is your ins and outs. If that gets to a point where you're actually not spending all of your monthly disposable income, or you could put some aside because we can all spend it, then we open up savings accounts, which are fairly accessible. Really, you should be able to get the money quite easily. And we often, I'm going to come on to talk about this, an emergency fund. We recommend you either have 3 times your net income, monthly income saved, or £15,000 as a minimum. So whatever is the highest figure, so lowest figure, should I say. So if you don't have an emergency fund, then you're going to need to spend the money that you've invested over the medium to long term. So my first advice would be always to build up an emergency fund that you can rely on over the next 5 to 10 years, including any potential spend. And then any monies that you feel that you could look at over the next 5-10 years, that's where it would be best invested. So the emergency fund is key. Otherwise, you are going to need to take money out of an investment, and that defeats the object of it.
Right. Now, the other thing is, just before we move on, I know there's 3 more areas left. Just very quickly, is about what if people have got this bit of extra cash, but what if they meet someone? If Alex or Nikki meet someone, they might not want to be pouring all their, monies suddenly into investments. They might want to invest in, a startup business, for example. I know a few entrepreneurs who've got little startups. They don't do anything interesting or great, but they might want to do that. So at which point can people make the distinction between doing that and actually investing in one of the other 4 areas while having cash?
Well, that is the first thing I always say to people is, what are you saving for? Because if I don't know what you're saving for, then it's going to be difficult for me to advise you where to put your money. So if you said to me, in a couple of years' time, I might start a business, to me, that means that money is going to be spent in the short term. So I'd probably recommend you kept it in cash. But on the other hand, you may still be able to save on a regular basis, because pension funding is incredibly tax efficient. So we've got to weigh up what you're going to gain by keeping the money accessible, because you might start a business, you might have real big aspirations to do that. But on this point of trade, if there's sort of a business acquisition or change, if there's a romance, you need to really be reviewing your finances regularly, because I can only really talk to you and have a snapshot in time of where you are today. So a lot of people, they think, oh, I've done it, thank goodness, that was dreadful, but I've sorted it, I'm never going to have to think about it again. But that's the worst thing you can possibly do. You really need to be reviewing your finances biannually or annually, so that I know if there's a change come up. And I sometimes say to people, the clients I know and I regularly review, I'll say, well, you've just told me you might do this, so let's stop this and keep some more money accessible, so that you've got the freedom to do that. So reviewing is key to any change. Talking to me and giving me a whole understanding of your short, medium and long-term plans will help me to earmark. And just like, some of the older clients I've had, they had pots, of money for gas, electric, water. They used to pot all their cash up. That's what you should be doing with your money. So the money that you may, could, should, ideally would like to spend in the next 5 years, keep accessible. But if there's any monies that you can afford to save over the medium to long term, that's where we can look at that without, exhausting it. But you must review it. Does that sort of answer things?
Yeah, it does. Yeah, let's bat on. I've got 2 questions later at the end about.
Oh, exciting! Right, let's carry on this.
About handbags and.
So pensions. Should I access this now? Do I bother with a pension? Oh, I've got massive shortfalls. You really need to probably speak to me, because pensions are incredibly beautiful because they're very tax efficient havens. But most of us hate them because A, they don't understand what they're doing. B, pension rules have changed. I did a thing 10 years ago, pension simplification, and it's not simple. They keep changing the rules. The governments keep talking about, you know, they could change how they tax you on it. So pensions are really wonderful things, but you cannot access the money until you're age 55, and that might go up slightly. All of us know that we're going to probably retire when we're 156 because the state pension age just keeps going up. So what you put in is kind of what you get out. And probably if I spoke to all of you, including myself, we probably all have shortfalls within our pension funding. But it's really important to look at the long term, not just think, oh, you might get a letter at age 55 going, oh, you can take your money. Probably not the best idea if you're earning money because you'll be taxed heavily potentially. So it's an area where you definitely should review it. Always maximise your work benefits, because that's the place where you might get free money. Even with the basic auto-enrolment schemes, it's likely you can put in 5% of your income and the company will put in 3%. There are very few places that will give you 3% of your income for free. So it's really important that you maximise and you try and push your pension planning, because I'm going to be honest, with women, I cannot tell you how many women I meet that are really vulnerable because they haven't saved enough within their retirement funds. And within the legal sector, doctors, dentists and teachers, they have it all done for them. They have really good government schemes, but often you don't have that. So you have to be really, really on it with your pension plans. So other ways to support your finances. Well, this is really, probably we might say, COVID has really affected most people, whether they've reduced their income, whether they've been furloughed. So there are a few things available. Do not bury your head in the sand. If you're struggling to pay for something, don't just miss the payment and then it all just goes into a nightmare, collections. I used to work in banking, so I know the spiral that people get into. A lot of mortgage providers have allowed you to take a payment holiday, and it shouldn't affect your credit score. However, do realise that all the interest that you would have paid within your monthly payment will just be added onto the mortgage debt. So just because you're allowed to do it, it's not probably going to affect things. It could actually cost you money in the longer term of things. So only do a payment holiday if you feel you cannot afford your mortgage. Also, you can take payment holidays, I think, on credit cards, or that, you know, a lot of companies want to support you with the regular debts that you may have. But again, don't just miss a payment, because the minute you miss a payment, it will affect your credit score. If you've agreed it with the provider, they are generally able to help you. And on that point, where a lot of lawyers don't have time, I meet lots of them that miss credit card payments by, or pay them late, or go over their overdraft. They are all areas which do not help you long term, especially if you're being credit scored for anything. So always set up a direct debit on your credit cards so that the minimum payment comes out at the right time. If you can overpay, brilliant, but they only expect you to pay the minimum payment. If you don't, that can have a massive adverse effect on your credit file. And as a lawyer, you're very similar to me. You cannot really have a bad credit score to some extent without being asked about it professionally. So I'd really, really urge you that always talk to someone before you miss a payment or go over your overdraft, because it can be quite difficult. So that's really the code. Now, we've touched on building an emergency fund. Building an emergency fund is massively important. Yes, ideally you should have 3 months' salary saved, a year's salary, lovely. But it's really try and get into the habit of saving regularly. A lot of banks will have regular savings accounts you can slip into your actual normal current account and have regular amounts coming out. Try and get into a habit of saving so that if there are any emergencies, you use less of your credit card, etc. The credit cards and loans are there for a purpose, but if you have an emergency fund, it can often help with the long-term planning, and you can get on that ladder of paying into pensions or investments quicker. You can also look to overpay on mortgages. All the mortgages is a big fat loan. Some lenders do allow you to overpay. You can do that where you're not contracted to do it. You just set up a standing order to do it. So all of these things, if you spoke to me, we can discuss the merits of them. Some people it will suit, others it will not. But it's just really important that you always talk to someone. Do not bury your head in the sand, because the people that I see do that, it sometimes means they pay a hell of a lot more on their mortgages, and they pay a hell of a lot more on their loans because they've ruined their credit scores. So really, in summary, financial well-being planning is really giving time. I have not been able to become a psychic reader of minds, unfortunately. I wish I could. I do not psychically know what's in your bank account, what you spend money on, or what your aspirations are, or what you're looking to do in life. So you do need to earmark time, and you do need to, when you speak to me, have an idea of what your income is, expenditure, assets and liabilities. Look, we will talk about short, medium and long-term plans, and it can initially be like pulling teeth. I will tell you now that when I start talking to people about where's your mortgage held, what's the interest rate, I see them glaze over and think, why am I here? But it's an investment, because hopefully once I know stuff about you, I don't have to ask you again unless anything changes. Protect yourself. Sometimes that's understanding the benefits you already don't know you got. The company weirdly don't advertise it, but they give you some amazing benefits that you don't realise you've got. Utilise them and make sure you know them. If you are in hospital in a coma, it's probably not going to be you claiming on them. Or if you've died, it will be your beneficiaries that have to do it. So make it easy for them to hunt out what benefits you get through work and what benefits you've already got, and make sure they're fit for purpose. And review things regularly. Review your mortgages, your debts, your retirement planning, so that when you have to make big decisions, it's not horrific because you're used to reviewing them. So the next step, well, I can help you. The great thing about Wesleyan is we set up appointments. There is no obligation generally to speak to me. There's no charges. Sometimes as we go through things, there might be things that we need to consider. But initially I can help you and discuss things, and you've got to worry about, the clock ticking. And, keep in contact as well. Make sure that even if we have a chat now and it isn't the right time, we can obviously earmark when it is and review it on a regular basis. But the key to anything is giving time to your finances. So I hope I haven't killed you by PowerPoint. Are there any questions from what I've gone through?
Yes. Firstly, let's do a clap for Natalie.
Oh, thank you.